and welcome to the first Monetary Policy Forum of the year. Thank you for joining us. Today is the release of the Annual Monetary Policy Review. With us on the panel, we have our MPC members, Governor Leseja Kganyago, Deputy Governor Cuban Naidu, Deputy Governor Rashad Kasim, Deputy Governor Fundi Chatsibana, as well as Chris Leopold, who is the head of the Economic Research Department. Our lead presenter for this afternoon is Witness Simba Nagabi. Kindly note that we are live streaming this session through our YouTube channel as well as Facebook. Please do submit your questions to our webcast. When you do, remember to include your name as well as your affiliation. Again, thank you for joining us today. I will now hand over to the governor who will give the keynote address.
Thank you very much, Mpho. Good day to everyone. Apologies for Chris Leopold. He might join us during the Q&A session. He's attending to other bank business. But what a time we are in. It is now 2 years since the onset of the COVID-19 pandemic, which has caused enormous economic volatility and hardships. Fortunately, the recovery has been robust as societies experimented, innovated, and learned how to best address the virus and its economic repercussions. The recovery has also been fast, occurring mostly within a period of 18 months. Unfortunately, many countries have failed to recover as rapidly as others, making it critical that the international community pushes harder to provide support to those countries that are less fortunate. With recovery and its many inconsistencies, however, we have moved rapidly from a severe recession to a great inflation. Progress towards more predictable and stable economic conditions remain under threat. Price pressures have intensified as demand has recovered quickly, while supply chains have been slower to recover. The war in Ukraine has exacerbated global price inflation while dragging down global growth. Price pressures are also evident in South Africa. Headline inflation has risen and remains above the target midpoint since May 2021 and has reached a high of 5.9% in December. Inflation is projected to remain high in 2022, but to return closer to the midpoint of the inflation target range next year. The domestic economy is now close to full recovery, being less than just 2 percentage points from the 2019 output level. Some sectors have more than fully recovered, while others remain challenged. Employment has recovered at a much slower pace than output has, reflecting some fears of permanent scarring that could have taken place in this economy. In these conditions, monetary policy needs to maintain its focus on its primary responsibility, and that is that of price stability. That we need to be keeping inflation in check and making sure that inflation does not run away from us. Keeping inflation low is important to support a recovery to better long-term growth prospects. This monetary policy review that we are going to present today captures the work that we have seen in the past 3 MPC meetings. And it is a worthy read and consists of very useful information that we hope will contribute to the discourse about the South African economy. We have on the panel today Deputy Governor Cuban Naidu, Deputy Governor Rashad Kasim, Deputy Governor Fundi Chasivana. The head of economic research, Dr. Chris Lovald, might join later during the Q&A session. As I have said earlier on, he is busy attending to other bank business. Our presenter today is Dr. Witness Simbanagavi, who will do a brief presentation, and then we could spend a lot of time interacting with each other. Witness, over to you.
Thank you very much, Governor. Let me just project. Okay, afternoon to listeners. Again, thank you, Governor, for this opportunity. So I'm going to walk us through this presentation. I will try to be quick, Governor, so that we have enough time for discussion after this. So the headline points that we want to really sort of give you up front are as follows. So the first thing that we want to highlight is that we expect global growth to slow quite substantially amid new risks that have emerged. And of course, we want to also point out that global inflation is sharply higher, and it has turned out to be more persistent than previously thought. And of course, because of the high inflation, global rates are actually normalizing. And this has been expected for some time. I think the question really is about the speed of the normalization and also the risks attendant to that. The other point we want to bring up front also is that South Africa's growth is slightly stronger, so it's actually revised higher, and largely because of the terms of trade effects or the positive terms of trade from the commodities. Of course, as the governor just pointed out, domestic inflation is much higher, and we have seen its expectations also lifting up, and of course, medium-term pressures, while they have been subdued for a long time, actually we have seen them starting to rise. However, policy remains supportive, leaning against inflation risks. And the last point, major point I want to bring up front is that the rand has been supported by the recent development in the global economy, which has helped to dampen inflation, imported inflation in the economy, but risks actually have raised. So just showing here in this slide, the fact that we project a marked deceleration in global growth. And as you can see, for the March MPC forecast, we're actually projecting a global growth of 3.7% in 2022. This is significantly lower than what was projected in November, at the November MPC, where global growth was seen at 4.4 in 2022. And the same applies to 2023 as well. We revised global growth lower. Just to point out that our global growth is really trade-weighted global growth. And just to try to understand and unpack again why we revised global growth lower, the main reason really is that inflation is sharply higher globally. And as you can see on the left-hand side, inflation, which really almost went into deflation at the depths of the COVID crisis, has risen sharply in the advanced economies, rising to levels last seen in the 1980s, for example. In the US in February, inflation was seen at 7.9%, again, a level that was last seen in the 1980s. Similar high levels of inflation are also seen in other advanced economies, especially the Eurozone or Euro area, and of course, the UK, Japan being somewhat of an exception here. If you look at the right-hand side chart, to understand again why we see global growth slowing, here we see that as inflation has risen, forecasters have actually revised their forecast for household expenditure lower over time, as high inflation erodes household sort of consumption, household real consumption or purchasing power of money. And of course, if you look at the right-hand side chart, you see especially for the Eurozone, we see a very sharp drop in projected household expenditure, which is again maybe a combination of the high inflation as well as the recent sort of developments with the Russia-Ukraine war, which would likely impact the Eurozone substantially. Of course, inflation is also markedly higher in emerging economies. Here we show a couple of economies, selected peer emerging market economies, and we see that inflation is substantially higher, for example, in Brazil, Poland, and also India, among others, and largely driven by petrol and of course food, which is also substantially elevated. Again, as I just pointed out, we see that oil prices have risen sharply. First of all, we saw a strong recovery in oil prices in 2021, but of course, at the beginning of this year, we saw a marked sort of increase in oil prices in response to the tensions in Eastern Europe, which obviously Russia, being a major oil producer, is added to oil price pressures. Of course, the strong recovery in oil prices was largely driven by the strong recovery in the global economy, and of course the fact that the global recovery actually was sort of tilted towards goods demand, and of course goods are very energy intensive, which sort of supported the demand for oil. But also the supply of oil was constrained as some of the OPEC members were not able to meet their quotas, sort of restricting supply. Another factor that has driven price pressures globally is elevated food prices. We saw the last year that food prices rose quite sharply, and of course, at the latter part of last year, we saw some moderation in the global food prices, as measured by the UN Food and Agriculture Organization Index. But we have seen that again, as the hostilities in Eastern Europe flared up, we have seen actually price pressures strengthening for food, driven by oils and also cereals. And this is largely because both Russia and Ukraine are major producers of grain crops and oil. So that the disruption to the supply explains the recent sharp increase in these prices. Other factors that have contributed to heightened inflation include tightening labor markets in advanced economies, especially in the UK and also in the US. We have seen labor markets tightening substantially. Of course, the other factors include the supply chain bottlenecks that we have seen since last year. And while it's, as we can see from the chart here, with the Global Supply Chain Pressure Index, which is an indicator, a measure of the ability of supply chains to meet demand, and we see that it rose sharply. And of course, there's some moderation, but it remains very elevated. And this is contributing to higher inflation. Of course, with higher inflation, we have seen that countries have moved to remove policy accommodation, both fiscal and monetary. And on the left-hand side chart here for advanced economies here, we see again that as the pandemic hit, there was a substantial policy support that was afforded to the economies. And of course, as inflation has risen and recovery has taken root, here we see that actually countries have begun to withdraw the accommodation, the fiscal accommodation. And of course, on the right-hand side, we also see that these are projections or forecasts of policy rates in the advanced economies. There's a strong expectation that interest rates will actually start rising in the advanced economies. Of course, we already know that we have seen in the US, the Fed has raised its rate by 25 basis points in March. The UK, as Bank of England, has already raised its rate at least 3 times since December, now sitting at 0.75%. I think where there's a bit of uncertainty is the euro area, especially given the hostilities in Eastern Europe. And of course, we have already saw that for emerging markets, a good number of them have already raised their rates quite substantially. And this is because inflation sort of flared up quite strongly last year, driven by oil and food prices. And these countries moved to actually try to contain the inflationary pressures by raising their rates. And here we see, for example, Chile and Brazil, rates are fairly, policy rates, nominal policy rates have been raised quite substantially. Of course, the Russia-Ukraine conflict has also added to or brought about increased risk and uncertainty in the global economy. And at the same time, of course, it has supported also commodity prices. Here, we just try to show you the bond market volatility as measured by the MOVE index, which has risen to levels almost last seen at the onset of the pandemic in 2020. So that's the level of uncertainty in the global economy, impacting, of course, financial markets. But of course, on the positive side, especially for a country like South Africa, which is very strong in commodities, is that commodity prices have risen sharply because of these hostilities. Here we show that, of course, oil prices have also risen, but most of the commodities for which South Africa is a major exporter have also benefited substantially, which should benefit the terms of trade for South Africa. Apologies. Of course, the hostilities have not only benefited commodities, but they have also supported the US dollar. And there are sort of several reasons why we see this. The first is that, of course, what has happened is that expectations for short rate movements in the US against other advanced economies have favored the dollar. And so we have seen an appreciation of the US dollar. Okay, apologies for that. So the dollar has strengthened because of, on the one hand, because of the short rate expectations differentials between the advanced economies, where the US is expected to continue to normalize its policy rate, while the other major advanced economies, especially the G3, the Euro area, there are sort of maybe questions around the timing of when they will start moving. And in Japan, of course, the inflationary pressures are not as strong, so they are not necessarily expected to be moving at this moment. On the right-hand side, here we're just showing that while the impact on the emerging market currencies has been diverse, some countries or some currencies have actually strengthened because of the commodities, while some currencies have sort of weakened. And here we see that Russia and Turkey, there are a bit of exceptions, and this is largely because of idiosyncratic factors in these economies. And of course, portfolio flows, looking at portfolio flows, we see that EMs have experienced a net outflow given the hostilities that we've seen in Eastern Europe. But I think what is interesting also to note is that these numbers are driven largely by China. So probably 80 to 90% of the movement in the flows is related to China. And one could sort of surmise that probably investors may be worried about the possibility of contagion, given the sanctions that have been imposed on Russia. So they are trying to move their assets before maybe China is entangled in this conflict. And on the right-hand side, we see that for South Africa, yes, we have sort of benefited, especially the equities, which have benefited from strong commodity prices, but we also are in the same basket with the other emerging markets. And moving to the domestic economy, we see that the recovery in the domestic economy has been strong, as projected on the left-hand side chart here. And we saw that we had growth of 1% in the first quarter of last year, 1.3%, and then we had a sharp drop of 1.7% in the third quarter, but a strong rebound of 1.2% in the fourth quarter. And looking at the GDP level, we can see that at the moment, as of quarter four, 2021, quarter four, we are sitting at around 98.5% of the 2019 average. And we do expect that the economy would recover to the 2019 level of output by the third quarter of 2022. And this recovery that we have seen has been underpinned by strong household consumption and of course, improving finances or household finances. And on the left-hand side chart, we're just showing that there's a very strong correlation between household finances or financial assets and improvements and also expenditure. As the household assets benefit from the economic environment, we see that households actually consumption increases. And on the right-hand side, what we're showing you is just that household debt is actually declining as a share of household disposable income, which is actually good for household consumption. And of course, we also see that net wealth is improving, again, benefiting from one, the low interest rates, but also what's happening with equities as commodities perform. So, and part of the recovery that we have seen also benefited from a supportive fiscal and monetary policy. And here we're just showing you that, of course, the government, the public sector or government increased spending during the depth of the pandemic, reaching 10% of GDP. And on the right-hand side, we're just showing you that the real repo rate gap, which is the difference between the real repo rate and the neutral real rate, is substantially negative, which is providing support to the economy. However, taking a supply side view, there are concerns around likely scarring of some sectors. Here we can see that 3 of the sectors have actually recovered to beyond their 2019 level of output, and these are agriculture, finance, community and social services. But of course, we also see that some sectors, especially construction and transport and also trade, they remain far below their 2019 level of output. And this is, of course, the differential rate of recovery is of concern, particularly given that some of these sectors are very labor intensive. So their slow recovery is actually impeding economy-wide recovery in jobs, which is a concern, as we can see in this chart, that the recovery in jobs has been very slow. And at some point, we have seen some actually loss of jobs, especially in the 3rd quarter of 2021. And comparing the second quarter of 2020 and where we are the 4th quarter of 2021, actually the net job creation sits at under 400,000, which is low given that we lost a lot of jobs during the pandemic. However, we are sort of optimistic that given that growth is expected to improve going forward, that could help to create opportunities for employment. So we project the 1st quarter growth at 0.8%. And of course, as I mentioned earlier, we sort of revised our growth for 2022 to 2%, up from 1.7% during November and also January. And this is largely because of the terms of trade, given the strong performance of the commodities, but also the low interest rates continue to support the economy, and so as a result, feeding into higher growth. So I've spoken to this. And of course, the stronger commodities are also helping generate company surpluses for corporations or gross operating surpluses. And of course, this is also helping to improve business confidence, as we can see on the right-hand side chart. Here, if you look, you would see that the current level, even though it's still relatively low of business confidence, is significantly higher than what would consider as the average, the pre-pandemic average. So it does suggest that business confidence is indeed improving. And of course, we can also see the improvement in the business confidence by looking at things like investment. Here we see that there is an indication that investment, especially private sector or private business enterprise investment, is actually improving since about the 1st quarter of 2021. And of course, the spending is actually has increased in machinery, which we think is good for growth and also for employment creation. And net exports are expected to support the current account going forward. Because the commodities are doing so well, we do expect the trade balance to remain strong. and with it, of course, the current account will remain strong, and we see it remaining in positive territory or in surplus until over the forecast horizon, which is significantly better than what we had projected during the previous MPR. And the commodities have also benefited the public sector. Here we see that public debt, there's been a substantial improvement in public debt, which is now seen leveling at 75.1% in 2024-25, 3 percentage points lower than what was projected during the MTBPS in 2021. And also here we see that the bond yields have also benefited somewhat during this period, especially the long end of the yield curve. Now moving to inflation, we see that headline inflation is sharply higher, and this is driven largely by non-core components, as we can see in this chart. Yeah. So to sort of break down the composition of this and the drivers of headline inflation, we see that in 2022, actually fuel prices are the main driver of higher, substantially higher headline inflation relative to what we had forecasted. And of course, over the medium term, we see that actually core inflation becomes much more important as a driver of headline inflation. So just looking a little bit in more detail as what's happening with oil prices and fuel prices. Here we see that, of course, the oil prices have soared substantially, and they are feeding straight directly to the pump prices. As we can see, our forecast for 2022 is that oil will settle at, will average $103 per barrel, which is substantially higher than what we had projected in October last year. And what we can also see on the right-hand side chart is that fuel prices have progressively, sort of risen. Fuel price inflation has progressively increased. If you look at the November to January and then, of course, to March, it's substantially higher now, but it is expected to come down quite strongly in 2023, partly due to base effects, and partly because we do expect the oil prices to moderate substantially in 2023. Risks to inflation will also emanate from rising agricultural input costs and supply disruptions as a result of the conflict in Eastern Europe. So in terms of the costs, part of the fertilizers are expected to escalate quite sharply. And of course, Russia is one of the major suppliers of producers of fertilizer, and that might impact supply of inputs to agriculture, including in South Africa, because we do import a lot of our agricultural inputs. On the left-hand side chart, we see the futures for maize and wheat, which have risen quite sharply relative to market spot prices. But even the spot prices have been increasing as well over the recent time period. And these are going to feed into elevated food pressures. And of course, we see our projection for inflation remaining higher than what we had in the October NPR. So we project inflation to settle or to average 6.1% in 2022, which is the same as it averaged in 2021. And the concern that we have is that the rising core inflation will likely elevate headline inflation for longer. So if you look back to 2018, between 2018 and 2021, we saw that core inflation was quite modest. And as a result, headline inflation was also quite modest, remaining very close to the midpoint of the target. But the fact that core inflation is rising over the focus horizon is a bit of a concern, because then it means we would have to rely on other non-core items disinflating faster to keep headline within the target. So what we show here is just the trend of core inflation, which began, as we can see, the core goods drove the disinflation that we saw from 2017, driving core inflation much lower. And of course, we saw also services inflation trending lower until about 2021. And this was driven by housing inflation, which decelerated quite sharply. And of course, more recently, medical insurance inflation, which has come out much lower than was even forecasted. But what we are also seeing here is that the benefits are likely to dissipate very quickly as core inflation is projected to rise quite sharply. And part of the rise in core inflation, of course, would also reflect the imported inflation component as the rand is projected to weaken somewhat, as I will also touch on just shortly. So part of the rise in core inflation is to do with the output gap, which is closing faster than we had projected in January, for example. And of course, the closing output gap does suggest that demand pressures are actually strengthening in the domestic economy. And part of the rising core inflation also reflects the rising sharply higher producer prices. And as I mentioned earlier, imported inflation, as we can see from the right-hand side chart, where we plot producer prices for our major import destinations or countries where we are importing from. But in the domestic economy, we can see that the intermediate PPI has risen quite sharply, recently moderated, but still remain very elevated. While the final goods PPI is also fairly high at 10.5% in February. And part of the rising core inflation would also come from wages, which are expected to rise faster than inflation, and which we show on the left-hand side chart. Whilst on the right-hand side chart, we show that in terms of the unit labor cost, the gap is closing rather soon. And then, of course, moving from being unit labor costs are moving from being disinflationary to inflationary. And these rising sort of core inflationary pressures are actually reflected in the rising inflation expectations, where we see the BER inflation expectations the inflation expectation as surveyed by the BER have risen above the 4.5% across the different horizons. And also we see the break-even inflation rates have risen in recent times, though there is some moderation in the very latter periods. Despite these pressures that are acting on core inflation, I think the rand is likely to play an important role as well. And the rand has benefited from more favorable global conditions, and has strengthened somewhat, which should help to dampen imported inflationary pressures. So the normalization of the repo will continue, or is continuing, and it has been gradual thus far. And as we can see on the right-hand side chart, the MPC has raised the repo rate by 75 basis points since November. And here we see on the left-hand side chart that the inflation remains well above the repo rate, which means the real repo rate is negative. And the negative real repo rate means it's providing support to the economy, but still also leaning against higher inflation. And so again, so to make the point that the real repo rate is negative. One of the reasons, of course, is that it looks through temporary supply shocks in the economy, which is helping to mitigate medium-term inflation. From a comparative sense, when you look at South Africa versus other EM peers, we see that real policy rates in South Africa are negative, just like in many other peers. And this is again because inflation has risen fairly sharply. And of course, as a result, driving the real rates into negative territory. But we view that these real rates, they will continue to support the recovery, but at the same time, sending the right signal in terms of impact on inflation. So to summarize, Governor, one of the points that we tried to make in this presentation is that global growth has been strong, but we see that global growth is actually decelerated sharply, or it's going to decelerate sharply. And the question is whether this will actually lead us into stagflation, or because there are questions around whether the landing will be soft or hard landing. I think that's remained an open question. And the inflation risks, global inflation risks at the upside, and this is exacerbated by the Russian invasion of Ukraine, which has driven both food and fuel prices higher. And of course, the supply constraints or supply interruptions of also food and fuel, which could worsen, because one part of the concern, of course, is that whether the EU would impose or start banning Russian oil, which would actually drive oil prices even higher. And coming back home, we see that domestic growth is revised higher, and this is largely because of higher commodity prices, and of course, terms of trade that have improved. But the question is whether how sustainable this increase in the terms of trade would be. If the war were to end, would these price increases be sustained for longer? That's an open question. And of course, we see some scarring in some sectors, and this is impacting job recovery overall. Inflation sharply higher, driven by oil and food. But of course, we see that also that the core inflation is rising as the output gap is closing, and imported inflation rises. And the trajectory for policy is trying to really balance support to the economy and, of course, keeping inflation contained. Thank you, Governor. I'll stop there.
Thank you very much, Witness. We are going to open for questions, and Mpho is gathering all of these questions through all the other platforms. She will read out the questions, and then we will share them between the MPC members.
Thank you. Thank you, Governor. We're having a bit of a slow start. We have one question so far, and that is from Nikki Sparks, a private citizen, and they want to know whether there's any monitoring and control of money going out of the country from the informal sector.
Is that the only question?
That's the only question that I have on my side.
Sounds like a question that has got Kuben Naidu written all over it. Just check if there isn't any more.
Governor, I just saw another one coming through. May I take that one as well?
Mm-hmm.
All right. It's a question from Annie Muremi, from also a private citizen. And their question is, how will the war between Russia and Ukraine affect the South African economy?
One more. Let's take the third one.
Okay. I'm waiting on my side for.
Okay, and then let me respond there.
Yes, thank you.
DG Naidu will respond to the question about the monitoring of money flowing out of the country through the informal sector. The impact of the war between Russia and Ukraine on the South African economy will come through a number of channels. Firstly, its impact on the global economy, and as a result of the war, everyone has revised what they think the growth in the global economy is going to be, and that obviously affects global demand. And for South Africa, as a small open economy, we are then affected through that channel. Secondly, is that both countries are also important commodities producers. Ukraine in the form of iron ore and grains, and Russia in the form of gas and oil. And as a result of this war, we have actually seen a rise in the prices of commodities, and we have especially oil and food prices. And as a result of that, that has fueled what we have seen on the inflation front on a global basis. Many emerging markets which tend to have households that consume a significant proportion of their income on food and to some extent transport. And you see that coming through. And this has added to the global supply chain constraints that we had seen. So the impact is going to be through slower growth, and that's the demand for South African products. And secondly, it is going through to be the rise in inflation, mainly food and fuel. But as we said in the presentation, there is another indirect benefit for South Africa, in the sense that some of the commodity prices that prices of the commodities that South Africa produces also began to rise, and South Africa thus experienced a positive terms of trade benefit. Clearly, these are benefits that are transitory because you do not expect a war to last forever. So those are the channels through which the war is impacting on South Africa. And the last one has to do with business sentiment. It has affected global business sentiment and making a lot of firms to rethink their investment decisions. But also the sanctions that got imposed mean that there is an impact on global financial conditions. And again, as we pointed out in the presentation, you have seen investors acting preemptively, and you have thus seen a flight to quality with funds going towards the US dollar away from emerging market currencies. And so that is the way in which we have seen the effect. But DG Naidu?
Thanks, Governor. Thanks, Mpo. South Africa is one of the few countries that keeps a comprehensive check and account of all electronic transfers across the border, be that by debit card, credit card, money transfer services, migrant remittance services, bureau de charges, banks. We keep a comprehensive account of all transfers, of all electronic transfers. We have a system where banks are registered as authorized dealers. Bureau de charges or money transfer services are registered as authorized dealers with limited authority. These are licensed, these are monitored and regulated by the Reserve Bank. However, there are people who do take money out of the country illegally. They could take it in cash. You'll know if you've traveled that there are limitations on how much of cash you can carry in and out of the country. But people do cheat, people do take money out. And there are all sorts of ingenious electronic and non-electronic or physical ways of taking money in and out of the country. We try to the best of our ability to limit these, to curb these, and to go after people who do take money out of the country illegally. We don't always succeed, but we think we play a significant role in helping to limit illicit financial flows. Thanks, Chair.
Mpo, any further questions?
Yes, thank you, Governor. We have some questions coming in from YouTube. The first question is from Gabriel Indombo, and they're asking what is the impact of the slowing Chinese economy on South Africa. And they also, I'll just leave it there. They want to know exactly what the impact of the slowdown in China and how they're going to impact the SA economy. Then we also, just going back to the impact of the Russia-Ukraine, we have a question from Bagang Guguseng, also from coming from YouTube, and their question is more inflation related, and they ask, you know, what is this? What is the war and other factors that are contributing to the current inflation status in the country? Then we have two.
Can you repeat that last question?
Sure. It's here is the question again. I will do that for you. So they want to know the key factors that are contributing to CPI inflation. So besides the war in the Ukraine, what other factors are contributing to inflation? Then we have two questions from Sumisha Naidu from the MBSA. The first question is there an outlook on the repo rate for the rest of this year? And in the USA, so on the back of, obviously in the USA, there's a lot of discussion about quantitative tightening, but some feel that this normalization cycle is a bit too late, and there are risks of a possible recession emanating. The second question, what they also want to know is what is the forecast for the rand-dollar exchange rate, and what is the big factor that is at play with regards to exports and imports. I will take those for now. Or do you want me to address more questions?
Okay. Fundi, I'm going to give you the stuff on the US quantitative tightening and the forecast for the rand-dollar exchange rate. And then, Rashad, can you take the question on factors contributing to inflation and the impact of the slowdown of the Chinese economy on South Africa? With respect to Sanisha, with respect to the outlook for the repo rate, we do not project what is going to happen to the repo rate. We are an inflation targeting central bank. At every meeting of the Monetary Policy Committee, we would take a view of what is going to be the evolution of the global economy, what would be the outlook for the South African economy, how the South African economy interacts with the global economy, and what it means for both growth and inflation. And based on that, we would take a view of the adjustments that we make to the policy stance that we have. The quarterly projection model, which is just but one input for our deliberations as the Monetary Policy Committee, has got an embedded path of 25 basis points at each of the subsequent meetings. But that is not a forecast. It just remains a broad guideline which changes from meeting to meeting. And the MPC meets at every meeting and deliberate on what adjustments to make to the monetary policy stance. We do not put a forecast of what the repo rate is going to be for the rest of the year. So, Rashad, Fundi?
Yeah, okay, I'll kick off. Can you hear me? Yes. Let me just say that on the Chinese economy, it's important to realize that we rely on global demand in part for our economic growth. So typically, if our trading partners grow, that has a positive spillover on our growth rates. But when you limit it to a country like China, there not only does Chinese economic growth have a particular impact, positive impact on our growth, but China in particular plays a very important role as a high consumer of our commodities in influencing commodity prices, and has very positive effects for us. So if the Chinese economy slows down, one of the obvious ways in we see a negative impact on the economy is a slowdown in commodity demand, although demand in other parts of the world can offset that effect. So if you look at on the question of inflation, if you look at our last MPC statement, there are a few things that are driving inflation Ukraine Russian conflict and during the conflict. In the first case, I think that there was a recovery from a massive contraction in 2020 at -6.4%. So prices went down to some extent. So we began to see prices normalizing from very low levels. But linked to that is we still have a problem in our price structure in this country that consumers pay a lot for what we call administrative prices, like electricity, like municipal rates and tax. When I mean a lot, the increase in prices. So those admin prices continue to contribute to upside inflation risks. Obviously, with the conflict, suddenly the major revision of the oil price in our inflation basket, as is the case in many parts of the world, has been the overshadowing upside risk to inflation linked to the food price, and the two reinforce each other. So these are the kind of things. In contrast, I think that there's still low demand in the economy, so core inflation remains within the midpoint of the target, and that's a very positive sign that at underlying inflation or inflation, for those of you who don't interact much with us, inflation without goods that are volatile is pretty stable around the 4.5%. Thank you.
Okay. Thank you.
Governor, if I can come in on my two questions. So if you can hear me, let me start by discussing the issue of quantitative tightening. So quantitative tightening refers to a central bank reducing the size of its balance sheet. So in the case of the Fed has been buying assets. So they've been buying government bonds, they've been buying corporate bonds. And so the size of its balance sheet is actually a lot larger. It is double the size that it was in 2019. And what the Fed has done now is it has stopped buying bonds and it has communicated that it will start the process of reducing its balance sheet. So when a central bank buys bonds, it is adding money or liquidity to the system. So by selling off what it is holding, it is going to take money out of the system. So that is what is happening with that tightening, that quantitative tightening. But at the same time, the Fed has announced with the spike in interest rates in the US that based on the information in front of it, it will start to normalize interest rates. And we have started to see that starting to happen. Now, how does that link to the probability of a recession? So historically, a recession, and I'm now talking about a recession in the United States, which is used as a proxy. Recessions have been triggered by the US Fed, or their central bank, increasing interest rate very quickly. The second trigger for a recession in the past has been very high commodity prices, and in this instance, very high oil prices. And that is what has happened in the past. And we are in a situation right now where the Fed is hiking interest rate in an environment where the oil price is also elevated. So those who make the projections around the probability of a recession in the United States are highlighting that the probability of a recession is quite high. And the general focus is on the United States because it is the largest economy in the world. So that's how those discussions are going on regarding the probability of the recession and how it is linked with the current developments. So the Fed is in a hiking cycle, they're increasing interest rates, and the oil price is at significantly high levels. With regards to the Rand-dollar exchange rate, even though we have our own internal forecast as a SARB, we do not publish this information because the Rand is a free trading currency. So we allow the market to determine its own price. We make our own projections because for our modeling purposes, we have to understand or have a baseline on how we think the interest rate will have an impact on inflation. But we don't publish this information, which is highly market sensitive. And it's because we are a monetary authority. So any position that we put out there, if we were to tell you that this is our expectation of the Rand-dollar price, that would certainly have an impact on what happens in the market. And that's not what we do as the central bank. So let me stop there, Governor. Thank you.
Thanks, Fundi. Thanks, Kubel and Rashad. Mpho?
Thank you, Governor. We have a few questions. The first one is on capital flows. It's also coming from YouTube. It's from Nokwanda Matenjwa, and they want to know what is the impact of portfolio outflows in the economy, specifically the socioeconomic and industrial development impact. Then we also have a question. This one is on domestic growth, and it's coming from Peter Montaldo from Intellidex. And he wants to know whether the SARB is concerned with composition of growth and whether that composition issue means anything for monetary policy. Then we also have two questions also on domestic growth coming from Naledi Ngobo from the SABC. And they ask, has the impact of supply disruptions due to rising COVID infections in China been factored into the domestic outlook, or is the forecast largely driven by rising oil prices and core inflationary pressures? The second question, also from Naledi, is to what extent do you expect these supply shortages to affect the positive trajectory of the current account? Let's take one final.
Positive trajectory of
the current account.
The current account. To Governor Kibet. Then we'll just take one other question. And this one is on employment. And that is coming from Sean Lakey. And they ask, given that employment is skewed towards educated workers in the economy, will the desired GDP growth be reached with so few educated workers active in the economy?
Thank you very much, Rashad. You'll take the question on employment and the composition of growth. And then, Kuben, I'm going to give you the one that you asked about, the supply and the current account and the supply chain disruptions. And Fundi, can you take the one on the impact of capital flows on the economy?
Okay, let me kick off. Yeah, I think Peter asked a really interesting question for monetary policy. You know, because we operate at the aggregate macro level, you know, it's growth that matters. I think that in general, I think that where the composition of growth matters is, you know, the underlying mechanics of how we think about the composition of growth and what that does to productivity, and in the end, what that does to potential growth. And I think that that's an interesting question. It is not something we have the luxury to look at every MPC meeting, but I think that the composition of growth will influence the way we think about the long-term productivity and ultimately more directly on the potential. Now, that is also in itself not a straightforward issue because, you know, if one assumes that, you know, tourism services are growing more than manufacturing, it doesn't automatically mean that productivity in the manufacturing sector is higher than productivity in the tourism sector. There may be parts that are highly productive. So I think that MPC monetary policy from time to time has to review the underlying sources of growth, and that will influence its thinking in a more nuanced way than at an MPC meeting once we've decided the composition of growth has changed. On the issue of employment, I think that, you know, this has been obviously, it is always the case that that the educated, those who had opportunity to get skills, have a lower unemployment rate than the unskilled workers. And that's a major objective of society as a whole, is that everyone gets educated. Now, but it is also the case that unemployment amongst educated workers or the skilled workers has also grown. So there is more unemployment that there used to be in the past, given the state of the economy. It's very unfortunate that often, you know, economic growth can have a skills bias. So sometimes, you know, in the way that the economy evolves, there's often a higher demand for skills. So the skilled workers get absorbed, but skilled workers getting absorbed in the economy can have very positive effects for overall unskilled workers. So it is the case, but there's no automatic economic growth does create more jobs. To the extent of how much jobs it creates, or in economic jargon, the elasticity of growth to jobs differs from time to time. Sometimes going back to the composition question, if the economic growth is associated with tourism and tourism is more labor intensive, then you do create better opportunities for unskilled or low skilled workers. And that's how it works. It's not an automatic, it is always good for jobs, but that relationship between a growth of 1% of GDP leads to what percentage of jobs is not a straightforward one. Thank you.
Governor, if I can come in on capital flows. So not all capital flows, outflows are bad. So sometimes funds flow out of the country when companies are making investments out of South Africa. Now, those types of capital flows will have a positive return over the long run, because those companies, when they make profits where they are, will generally repatriate those profits. So over time, there is a positive impact. And in terms of how we account for our international position as a country, those assets that are outside of South Africa would have a positive contribution. But let me talk about the types of outflows that I think are being highlighted here, which are not necessarily always beneficial. So when you get outflows of capital, those outflows generally come out of savings. Now, if those outflows are from residents, that means that our national savings are declining in real terms, and those funds are going out, and that has an impact on how much savings are available in the economy to be invested in various activities, and that would have an impact in industrial development over the longer term, because you are shrinking the size of capital that is available in the economy for savings. Some of the capital outflows that you're seeing, though, is capital outflows which were funds that non-residents had invested in South Africa. And in some instances, those capital outflows are reflecting that those foreign investors are no longer getting a large enough return in South Africa, and they're taking their money back to reinvest it elsewhere. And because we don't have a large savings pool in the country, we generally rely on savings from non-residents. So we aim to attract capital from outside of South Africa into South Africa. So that does result overall also in a lower availability of funds that are there for investment. Now, the other factor, of course, that has an impact on the funds that are available for investment is how much is being taken by who. So if government is borrowing a lot more relative to what businesses are needing, that does result in what we call I don't know why I've lost this word. It does result in a displacement of that capital that the private sector would be utilizing for investments as well. So we do take an interest in what is happening to capital outflows in South Africa as a SARB. It's an area that we look at. It also indicates to us how investors perceive the domestic conditions. The governor spoke earlier about business confidence and investor confidence. It's also an indicator that business or investor confidence might not be as low, as high as it should be, that it's lower than it usually is. At the same time, capital outflows are also a reflection of what is happening elsewhere in the world. So when the governor was answering the question on the war between Russia and Ukraine, highlighted the fact that when there is uncertainty in the global investment, in the global environment, investors do get nervous. And so that does have an impact on where they take their monies. And the term that I lost earlier was is crowding out. So what happens if one of the economic agents in the economy is using more funds than the other? But overall, if you get capital outflows, whether it's outflows from domestic investors or it's capital outflows by non-residents, that does result in an overall shrinkage in the size of the pool of savings available. Back to you, Governor.
Governor, if I may just take the one question. So if you look at the SARB's forecasts in November and perhaps even in January, our view was that the current account surplus is likely to shrink over time and to return to a deficit. In general, South Africa has run a current account deficit. Now, there's two reasons that explain this current account surplus over the last 2.5 years. The first is very weak growth in South Africa, so low investment, low imports, constrained household consumption, and significantly weaker private sector investment has constrained imports. And on the export side, higher commodity prices. Not so much volumes of commodities, but prices of commodities. And those two factors in the main have explained the current account surplus. It was our expectation that it would reduce significantly back to a deficit. But with the recent increase in commodity prices, it is our view now that that current account surplus is likely to be a bit more persistent, likely to last a little bit longer. But let me be clear that these gains, these terms of trade gains, at the moment are largely on the price side. They're not yet on the volume side. They'll really start impacting on GDP positively if you get a volume increase, or even better, that's when you're really likely to move the dial. Our view is that we've seen higher commodity prices as a result of the war, but that it is not likely to last forever. And in the monetary policy review, there is a graph showing our projections for the terms of trade. The terms of trade is very high at the moment. The terms of trade is the ratio of the prices of our exports divided by the prices of our imports. It's very high at the moment, but we think that it is likely to reduce from here on over the next year or two, gradually, not suddenly, but it is likely to reduce. Thank you.
Back to you, Mpho. We have got 19 minutes about for both the questions and the responses.
Okay, that sounds good, because I do have a few questions. The first one is coming from Tule Tizwani from the Business Day, and they want to know how high inflation in the US impacts the bank's thinking on policy going forward. Then Fanny Brink, he's a private citizen, and they want to know how effective higher interest rates will be in dealing with supply side shocks. Then we also have a question from Gabet Mojapelo from the DBSA, and they want to know that given that GDP has been revised higher, what are the driving factors behind this upward revision? He also asks what is the MPC's view, if any, on the second round effects from the current supply shocks. The second round effects is on inflation. Then we also have a couple of questions coming through from our YouTube channel. Also state Matthias asks, what are the main drivers that will make the MPC intensify the pace of normalization?
Can you repeat that last question?
What are the main drivers that will make the MPC intensify the pace of normalization?
Thank you very much, Mpho. The first question from Business Day had to do with high inflation in the US and how it would affect South Africa. But it's not just inflation in one country that would affect us. What we have repeatedly shown, and also during this presentation, is that inflation is on the rise across the world. It's rising in the developed economies, in the US, in the UK, in the Euro area. It has risen in many of the emerging markets, peers from the South and from in Asia. And so what is in no doubt is that globally, inflation is rising. Now, us being a small open economy, we are clearly affected by developments that are taking place elsewhere in the world. We import, we export, and at some point we will also feel the rise in prices in those developed world. However, you need to be cognizant of what are the goods and services whose prices are rising. In some instances, you may find that the increase in prices is in non-tradable sectors in those economies. Those might not quite affect us in the manner that the rise in prices of the tradable sectors in those countries would affect us. What we have seen, though, is that the resurgence in demand and the recovery of economic activity across the world had not been matched by a supply response as supply chains had been disrupted. So when you analyze this thing, you can't dismiss it as this is just a supply side shock, but rather that you have got a resurgence in economic activity and supply is not quite responding. And if it was that simple, then it would have been much clearer. But it becomes more complicated because there are other developments that are taking place that are of a supply shock nature, like the impact on the rise in food and fuel. But at the same time that you see all of those, what you are not seeing is that there are a lot of moving parts at the same time that you have got to take cognizance of. And so Mujapilu raises the question of what would the second round effects be? Well, that is what we respond to. We cannot respond to the shocks, but we respond to what the shocks actually mean for the price formation process and how it gets itself manifested in the manner in which prices are set and evolve in the South African economy, which then brings this thing back to the response that we have actually seen in the US. Because you see, when you see this rise in inflation and you try to take a view, the initial view that was taken globally was that these rises in inflation were transitory and could be temporary. But what we are now seeing is that policymakers are coming to the realization that these rises in inflation could become of a permanent nature. And as a result, interest rates are normalizing faster than was initially expected. That is what we are seeing happening in the US, and we are seeing that happening in the UK. We are seeing that happening in other emerging market economies. And the question that was asked was, how would interest rates deal with those supply constraints? Interest rates are not responding to the supply constraints, but they are responding to the fact that economic activity that is resurging, you have not had supply that had responded, and those things are now becoming permanent. We have been in somewhat of a fortunate position in South Africa. And fortunate here is put in inverted commas, because we have not, although our economy has rebounded strongly, we have not seen inflation rise as rapidly as we have seen it happen elsewhere in the world. And what this has done was that it provided the scope for the South African Reserve Bank to respond in a measured manner to the rise in inflation so that inflation expectations do not become de-anchored. And we believe that this measured response that we commenced with last year is an appropriate way of responding to the pace at which prices are changing in the South African economy and what we see as driving those prices. And as we had alluded to, we are worried that inflation expectations are also starting to rise, although they are still within our target range. It is important to note that even as we have responded in the manner that we have responded over the past number of MPC meetings, monetary policy in South Africa remains accommodative. One of the slides that we shared with you earlier on showed that the real policy rate where it is now is below what is considered to be the neutral real rate, reflecting the accommodative nature of monetary policy in South Africa. And so, Mujapelu, you also raised a question about what had driven the upward revision in our growth forecast. Firstly was that the growth came out stronger than what we had initially thought it was, and that gave us a higher starting point. Secondly was that we had expected that the benefits from the terms of trade shock were beginning to whittle out. And if you remember, last year in November, we were talking of the current account surplus reverting to a deficit over the next number of quarters. However, what we have recently seen at the beginning of this year was that the terms of trade benefited paradoxically from what you had seen as the geopolitical tensions, and South Africa being a producer of some of those commodities, and some of those commodities are also produced by Russia, but Russia now cannot quite be part of this global supply. South Africa benefited from that. So commodity prices had risen, and South Africa had benefited from the terms of trade shock. And how had this fed itself into our domestic economy? We had seen that nominal GDP is higher, and with nominal GDP higher, we saw that the government tax take became higher, and as a result, government was able to report much healthier fiscal accounts. But this all has to do with the fact that you have had these positive terms of trade shock, and this positive terms of trade shock is not something that is going to be permanent. At some stage, it will whittle out. But for now, we expect that it is having this positive effect on growth for this year, and hence our revision of growth. The revision of growth higher have not been that substantial. We revised growth up from 1.8 to 2%. And we must say that even at 2%, once we revised it higher, this level of growth, this rate of growth, rather, is not adequate for South Africa to deal with the unemployment challenges that we had faced. And as we said earlier in the presentation, that there seems to might have been scarring that had taken place, that there are jobs that might be lost permanently. On a net basis, there have been only 400,000 jobs that have been created, and employment is still below its 2019 level. So we are still faced with those challenges, and we have said before that this has given us space. It's not the time for us to rest on our laurels, but it is time for us to take those bold structural reforms that are necessary to raise the potential growth rate of this economy so that we could deal with our unemployment situation in a much more sustained basis. The last question had to do with what would the SAP consider to intensify the pace of policy normalization. But this question seems to suggest that the SAP is targeting interest rates. We are not targeting interest rates. Interest rates are an instrument that we use to achieve our policy objective. And in this case, our policy anchor is the inflation target range that we have set, and we expressed a view that we would prefer that inflation expectations are anchored closer to the midpoint of the inflation target range, being 4.5%. The outlook for inflation for this year says that we will be far away from the 4.5%, but that next year we will return to the 4.5%. And that outlook that we have placed is taking account of the policy actions that we have taken, and we will remain alert, guided by the evidence that is coming from the data, and thus calibrate policy as appropriate to make sure that we achieve our target and ensure that we are at the same time protecting the nascent economic recovery that we have seen, which is why we have been acting in this measured manner that you have seen us do. Mpho, I think I have covered every question, but my fellow panelists might be having something to add to this. Nothing. Well, we have got 4 minutes. Witness, is there something from your side that you think that you would like to add to some data that might strengthen my story?
No, Governor. I think you have covered everything well. Thank you.
Thank you. Thank you. Well, Mpho, I'm not sure if we would be able to squeeze a question and an answer in the last 4 minutes that is left, or whether I should return the microphone back to you.
So you've thrown the ball in my court as to what we should do, Governor. We actually have one last question, if it's permissible for us to.
Yeah, if it's one question, I'm sure we can deal with it.
Thank you, Governor. This question comes from Mpho Mulopani from the RNB, and they ask, the SAR projects that unit labor costs will return to historical levels over the forecast period, which contributes towards higher core inflation. They ask, how does this tie in with the wage freeze in the public sector?
Okay, Rashad, I'm giving you this one. Or should I give it to Witness? Witness.
Thank you, Governor. So I think the issue that really what we look at is we are looking at private sector wages. So this does not take into account I think the assumption that we work with for public sector wages is about something like around 2% wage growth. So really we are speaking to private sector wages, and the projection is for these wages to rise by about 5.5% in 2022, rising to 6.7% in 2023, and then back to 6.1% in 2024. So these are largely private sector wages. And the concern really is that these rates of wage increases are above productivity. So if you look at the real wage increase, given the inflation rate, this real wage increase is above productivity. And that is why they are becoming inflationary for the medium term. Yeah, that's what I would say, Governor.
Thank you very much, Witness. Mpho, that concludes the questions from the floor and the responses of the panel. At this stage, I must then thank you for your directives, and I'm sure as the program director, you have the last word.
Thank you, Governor. This definitely does bring us to the end of our session. Thank you for joining us, and thank you for those who participated by sending through their questions. It was an interactive session, and I thoroughly enjoyed it. Our next MPF is in October, so we look forward to seeing you then. Cheers for now. Thank you.